Picture the single most catastrophic number the American stock market could ever produce, a decline so severe it makes every crash in living memory look mild by comparison. Not the 34% the market lost during the darkest weeks of the COVID pandemic. Not the 57% it lost during the depths of the 2008 financial crisis. Imagine an 80% collapse, 4 out of every $5 of value simply gone, wiped from retirement accounts, pension funds, and college savings plans across the entire country within the span of a single brutal year. Meet Jason, a 46-year-old software architect living in Portland, Oregon, who has spent 21 years faithfully contributing to his 401k with the same quiet discipline millions of Americans practice without ever really imagining what an extreme scenario could look like. His wife Elena works as a physical therapist, and together their retirement portfolio has grown to just under $850,000, the product of 2 decades of steady contributions, and mostly the market simply doing what the market has always eventually done. Then, over the course of one devastating year, a cascade of global economic shocks, corporate bankruptcies spreading through entire industries, and geopolitical tensions boiling over simultaneously combined to trigger the single most severe collapse in the history of American financial markets. This isn't quite as unprecedented as it might sound, because the United States has actually lived through something remarkably close to this exact scenario before, and understanding that history reveals just how long and how differently a crisis like this can unfold. The closest American precedent remains the crash that began on Black Tuesday, October 29, 1929. The Dow Jones Industrial Average had peaked at 381 points that September, and the initial crash alone wiped out nearly half its value within weeks. But the truly staggering part of the story isn't the crash itself, it's what happened over the following 3 years. The decline continued grinding downward through 1930, 1931, and into the summer of 1932, when the Dow finally bottomed out at just 41. 22 points, an 89% collapse from its 1929 peak, meaning a single dollar invested at the top had shriveled to barely more than a dime by the time the bleeding finally stopped. What makes this precedent genuinely sobering, rather than merely historical trivia, is how long the actual recovery took. The Dow Jones Industrial Average did not return to its pre-crash 1929 level until November of 1954, a full 25 years later, meaning an entire generation of American investors who bought stocks near the 1929 peak spent the remainder of their working lives waiting simply to break even before any real gains even began. By 1933, in the depths of the accompanying Great Depression, nearly half of all American banks had failed outright, and unemployment had climbed to nearly 30% of the entire workforce, a level of joblessness essentially unimaginable by modern standards. Jason's advisor points out something crucial here, that the stock market crash of 1929 didn't single-handedly cause the Great Depression, but the two became deeply intertwined, feeding off each other in a way that turned a severe market decline into a decade-defining economic catastrophe. If an 80% collapse of the kind Jason is now living through actually occurred, it would represent the single closest American echo of 1929 in nearly a century, a fact that terrifies him considerably more than any smaller, faster crash ever could. There's an even more sobering international precedent that Jason's advisor brings up next, one that unfolded not in some distant historical era, but within the living memory of most working adults today. Japan's Nikkei 225 index, the closest equivalent to America's Dow Jones, reached an all-time peak of nearly 39,000 points in December of 1989 at the absolute height of Japan's legendary asset price bubble. What followed remains to this day the most severe and most prolonged bear market any major developed economy has ever experienced. The Nikkei lost over 80% of its value over the following 18 years, grinding down through the 1990s and into the 2000s in a decline and so relentless that Japanese economists eventually coined a specific term for the era, the lost decades. The index did not begin a sustained recovery until roughly 2012, and astonishingly, it only fully reclaimed its original 1989 peak value in the year 2024, meaning it took 34 years, more than a third of a century, for Japanese investors who bought at the absolute top to simply get back to even in nominal terms. And when accounting for inflation over that period, some analyses suggest Japanese investors were technically still down in real purchasing power terms even after the nominal recovery was declared complete. One financial historian studying this exact episode noted with a certain grim precision that the only genuinely comparable bear market in modern global history is the one that gripped the Dow for 25 years following the crash of 1929, and that for a long stretch it appeared entirely possible Japan's ordeal would end up outlasting even that grim American record. This is precisely the range of outcomes Jason's financial advisor is trying to help him understand isn't purely theoretical. An 80% collapse isn't some invented worst-case scenario dreamed up to scare investors. It's a scenario with two genuine, well-documented historical precedents, one lasting a quarter century and the other lasting well over 3 decades. A somewhat less extreme but still highly relevant American precedent unfolded much more recently, within Jason's own working lifetime. The dot-com bubble, fueled by wild speculative enthusiasm around early internet companies throughout the late 1990s, saw the technology-heavy Nasdaq Composite Index soar an astonishing 582% between January 1995 and its peak in March 2000. When the bubble finally burst, the Nasdaq collapsed by roughly 78% from that peak, bottoming out in October of 2002 after erasing more than $5 trillion in paper wealth. Unlike the multi-decade recoveries following 1929 and the Japanese collapse, the Nasdaq's recovery, while still painfully slow by any ordinary investor's standards, took a comparatively swifter 15 years, finally reclaiming its March 2000 peak in April of 2015. Jason realizes something important looking across all 3 of these historical episodes side by side, that the severity of an 80% style collapse doesn't automatically dictate how long the recovery will take. The outcome depends heavily on the underlying cause of the crash, the strength of the economy's fundamental productive capacity. Once the panic clears, and the specific policy response mounted by central banks and governments in the aftermath. As Jason watches his own retirement account collapse from nearly $1 million toward less than $200,000 over the following months, he starts to understand a distinction his advisor has been trying to explain for years, without it ever quite landing until now, the difference between the stock market and the actual economy. These 2 things are related, deeply so, but they are genuinely not the same phenomenon, and the gap between them can widen or narrow dramatically, depending on circumstances that have very little to do with how many people are employed or how many goods are actually being produced. Economists who study this exact disconnect point out that the stock market represents investors' collective expectations about future corporate profits, a forward-looking, often emotionally driven prediction machine, while the actual economy, measured through employment figures, GDP, and consumer spending, reflects what's genuinely happening in factories, offices, hospitals, and households right now. During the earliest, most confusing months of the COVID-19 pandemic, this exact disconnect became almost impossible to miss, as stock indices recovered and even set fresh records, while unemployment simultaneously spiked to levels not seen since the Great Depression. A jarring contradiction that left ordinary people rightfully confused about what the market's daily swings actually meant for their own lives. The same principle applies with even greater force to Jason's hypothetical 80% collapse, and it becomes his single most important source of emotional stability throughout the crisis. Even as stock prices collapse to levels not seen in a generation, the actual productive machinery of the American economy doesn't simply vanish overnight. Factories that were manufacturing goods the week before the crash continue manufacturing goods the week after. Hospitals continue treating patients regardless of what the Dow Jones closed at that afternoon. Trucks continue moving groceries onto store shelves, and the overwhelming majority of working Americans continue showing up to their jobs the following Monday morning, because their employer's stock price falling on a screen somewhere doesn't instantly delete the actual products, services, and relationships that business has built with its customers over years or decades. What genuinely collapses during an event like this isn't America's underlying capacity to produce and innovate. It's investor confidence, a psychological and financial variable that, while it absolutely does eventually ripple outward into real economic pain through reduced business investment, canceled hiring plans, and tighter credit, is nonetheless a fundamentally different thing than the physical, human capacity of an economy to function. This distinction becomes especially critical for one specific group. Jason learns about during his research into how an event like this actually plays out across the broader financial system. The tens of millions of Americans who depend not on individual 401k accounts but on traditional employer pension plans. Corporate pension funds typically keep somewhere around 60% of their total assets invested directly in the stock market, meaning a collapse of this magnitude would inflict genuinely severe damage on pension funding levels almost overnight. The federal government's own backstop for these pension promises, the Pension Benefit Guaranty Corporation, exists precisely to catch pensioners if their employer's plan becomes insolvent. But the PBGC's own finances are directly and unavoidably tied to the same stock market gyrations, threatening the pension plans it insures in the first place. During the much milder dot-com collapse and the recession that followed it in the early 2000s, the PBGC's own financial cushion swung from a nearly $10 billion surplus down to an $8.8 billion deficit within just a few years, driven substantially by the twin blow of a depressed stock market crushing pension asset values at the exact same moment that a wave of corporate bankruptcies dumped underfunded pension obligations directly onto the agency's books. An 80% collapse, several times more severe than that early 2000s episode, would place extraordinary strain on this entire system simultaneously, potentially leaving millions of retirees who spent entire careers trusting a traditional pension plan facing real uncertainty about whether their promised benefits would arrive in full. Elena, watching this unfold, starts to understand why financial advisors so consistently emphasize diversification beyond simply owning stocks, since households and institutions with meaningful allocations to bonds, real estate, or other asset classes generally experience less catastrophic damage during an event this severe than those with portfolios concentrated entirely in equities. There's a psychological legacy to an event this severe that outlasts the market's eventual recovery by decades, and it's worth understanding because it shaped an entire generation of American investors after 1929 in ways that are still measurable today. Researchers studying household financial behavior have consistently found that people who lived through the Great Depression as young adults carried a measurably different relationship with risk for the remainder of their lives, often holding significantly less of their savings in stocks, even decades later, well after the economy had fully recovered and stock returns had resumed their long-term upward trajectory. This isn't irrational stubbornness, it's a completely understandable response to having personally witnessed nearly a decade of a wealth-destroying event that no amount of subsequent recovery could fully erase from memory. An 80% collapse of the kind Jason is living through would almost certainly produce a similar generational imprint, a cohort of investors, workers, and retirees who spend the rest of their financial lives instinctively more cautious, more skeptical of markets, and more inclined toward cash and other conservative holdings than they might have been otherwise, a pattern that itself can slow the pace of long-term economic growth, since fewer households channel savings into the productive investments that ultimately fund business expansion and innovation. There's also an inescapable global dimension to a crash this severe, since American markets don't collapse in isolation from the rest of the world's financial system. Historical precedent going back to 1929 shows that severe American market declines reliably spread across international exchanges within the same trading sessions, and the interconnected nature of modern global finance, with pension funds, sovereign wealth funds, and everyday retirement accounts across Europe, Asia, and elsewhere, all holding substantial positions in American equities, means a genuine 80% collapse would almost certainly trigger a synchronized global downturn rather than a purely domestic one. This international dimension matters enormously for a country like Japan specifically, given its own painful first-hand experience with a decade-spanning collapse of similar magnitude. And central bankers and finance ministries around the world would likely coordinate policy responses, much as they did during the 2008 crisis, specifically to prevent the kind of uncoordinated, country-by-country panic that made the Great Depression considerably worse than it might otherwise have been. Jason's advisor also walks him through the specific investment philosophy that separates investors who genuinely benefit from severe downturns like this one from those who simply suffer through them. A philosophy built around treating a stock not as a lottery ticket whose price you're hoping to guess correctly, but as fractional ownership in a real, functioning business, and with real revenue, real customers, and real long-term earning power. Under this lens, an 80% market decline doesn't necessarily mean the underlying businesses represented by that index have become 80% less valuable in any meaningful economic sense. It often means the price the market is willing to pay for a claim on those businesses' future earnings has become disconnected from their actual underlying worth, pushed down by panic, forced selling, and a temporary but very real disappearance of buyers rather than any fundamental collapse in what those companies actually do and produce. This is precisely the reasoning that has historically guided the most successful long-term investors through the worst downturns in market history. The recognition that a widespread public retreat from stocks, driven by fear rather than analysis, often creates exactly the conditions under which patient capital can be deployed most effectively, buying meaningful ownership stakes in resilient, well-managed businesses at prices that, in calmer years, would never have been available at all. None of this makes the experience of living through an 80% collapse any less genuinely terrifying in the moment, and none of it guarantees that any individual company or even the broader market will necessarily recover on any particular timeline. But it does explain why the investors who weather these events best tend to be the ones who can mentally separate a stock's daily price from the actual underlying value of the business it represents. As Jason and Elena work through the most difficult stretch of the crisis together, they also confront the more immediate, practical financial decisions that a collapse of this magnitude forces onto ordinary households. They cut back on discretionary spending, delay a planned kitchen renovation, and postpone Elena's hoped-for transition to part-time work, decisions that feel painful in the moment but that preserve their ability to keep contributing to retirement accounts throughout the downturn rather than being forced to sell depreciated shares simply to cover monthly expenses. Their financial advisor specifically counsels them against the single most damaging decision available during a crisis of this scale, panic, selling their remaining retirement holdings near the absolute bottom, since doing so would convert what remains, at that point, a devastating but recoverable paper loss into an entirely permanent, realized one. Precisely the mistake that historical research on investor behavior during severe downturns has repeatedly identified as the single most costly error households make during exactly this kind of event. Restaurants near his office grow noticeably quieter as households tighten discretionary spending. The car dealership down the street reports its weakest sales quarter in years. Homebuyers delay purchases as mortgage lenders, spooked by the broader uncertainty, tighten their underwriting standards considerably. Construction projects that seemed certain just months earlier get quietly shelved as developers struggle to raise financing in a market where investors have grown unwilling to fund anything that isn't absolutely essential. This is the wealth effect playing out in real time, the well-documented tendency for households to adjust to their everyday spending based not just on their current paycheck, but on how wealthy they perceive themselves to be overall, meaning a catastrophic decline in retirement account values ripples outward into reduced consumer spending almost immediately, regardless of whether anyone has actually sold a single share of stock. Unemployment begins climbing as businesses across multiple sectors shift from expansion mode into pure survival mode. Hiring freezes turning into layoffs as companies conserve cash in the face of evaporating investor confidence and tightening credit conditions. Jason spends one particularly difficult evening reading through detailed accounts of exactly how severe the human toll became during the worst years following 1929. Not because he enjoys dwelling on catastrophe, but because understanding the actual lived experience of that earlier crisis helps him calibrate just how serious his own situation genuinely is compared to history's worst case. By 1933, at the very trough of the Great Depression, unemployment had climbed to encompass nearly a third of the entire American workforce, a scale of joblessness that meant, quite literally, that millions of households had no wage earner at all for years at a stretch, well before the modern unemployment insurance system existed, to provide even a partial financial cushion. Nearly half the nation's banks failed outright during this period, wiping out the life savings of countless families who had trusted those institutions completely, a scenario that today's much more robust system of federal deposit insurance was specifically created to prevent from ever recurring at that same catastrophic scale. Understanding this history gives Jason a strange, complicated form of comfort, not because it makes his own 80% portfolio decline feel any less painful in the moment, but because it clarifies that the modern financial system, whatever its flaws, has accumulated nearly a century of institutional knowledge, regulatory safeguards, and emergency response tools specifically designed to prevent a repeat of the Depression era's very worst outcomes, even during a market collapse of comparable severity to 1929 itself. Meanwhile, government officials and financial regulators respond with the full arsenal of emergency tools developed and refined across nearly a century of prior financial crises. The Federal Reserve floods the banking system with emergency liquidity to prevent otherwise solvent banks from failing purely due to a sudden panicked withdrawal of funding. Congress debates the shape and scale of economic stimulus programs aimed at supporting unemployed workers and struggling businesses through the worst of the storm. Market regulators repeatedly trigger circuit breakers, the automated trading halts first introduced after the 1987 crash, specifically to interrupt exactly this kind of self-reinforcing panic and give markets a moment to breathe. None of these measures magically stop the underlying fear driving the collapse, but history suggests they meaningfully shorten how long the acute panic phase lasts and how much collateral economic damage occurs along the way, compared to the far more limited, uncoordinated policy response the country had available back in 1929, when the Federal Reserve was still a relatively young institution and no equivalent of modern deposit insurance, unemployment benefits, or fiscal stimulus programs yet existed to cushion the fall. Months into the crisis, something quietly begins shifting, following almost exactly the pattern that eventually emerged after 1929, after the Nasdaq's collapse, and after every other severe downturn in market history, however long each specific recovery ultimately took. Patient, long-term investors, the kind who study balance sheets rather than headlines, start recognizing that many fundamentally strong, profitable businesses are now trading at valuations not seen in a generation. Prices that reflect collective panic far more than any actual deterioration in those companies' ability to generate real profits over time. Entrepreneurs, rather than retreating entirely, begin launching new ventures specifically because history has shown that some of the most successful companies in American business history, from technology giants to major retailers, were actually founded or first funded during the depths of severe recessions, when competition for capital, talent, and customer attention was unusually thin. Jason remembers, somewhat painfully, advice he'd read years earlier and never quite internalized until living through the crisis himself, that market prices can swing dramatically in the short run, but the genuine long-term value of a well-run business is ultimately built through innovation, productivity, and sustained customer demand, not through whatever number happens to be flashing on a stock ticker during any single afternoon of panic. Rather than liquidating his remaining retirement savings in despair, which is precisely the decision his gut instinct keeps pushing him toward during the worst weeks, Jason continues contributing small, steady amounts to his 401k every single month, purchasing shares at prices that feel almost absurdly cheap relative to where the market stood barely a year earlier. It feels genuinely uncomfortable, almost irrational to keep buying while every financial news channel broadcasts unrelentingly negative headlines. But he understands, at least intellectually, that historically, periods of maximum fear have often rewarded exactly this kind of patient, disciplined behavior, even though no historical pattern can ever fully guarantee how any specific future crisis will ultimately resolve. Years pass before the economy genuinely begins recovering in a way that feels real, rather than merely technical. New technologies and entirely new industries emerge from the wreckage, the same way the technology sector itself eventually emerged transformed and considerably stronger from the ashes of the dot-com collapse decades earlier. Consumer confidence returns gradually rather than suddenly. Businesses cautiously resume hiring as demand slowly stabilizes, and stock prices climb not merely because of reassuring government announcements, but because underlying corporate profits genuinely begin improving as the broader economy heals. Looking back on the entire ordeal once the worst has genuinely passed, Jason arrives at a realization that mirrors almost precisely what serious economic historians have concluded studying 1929, studying Japan's lost decades, and studying the dot-com collapse, that the single greatest danger throughout the entire crisis was never really the 80% decline itself, staggering as that number remains. It was the powerful, deeply human temptation to abandon a sound, long-term financial plan during the exact moment when fear reached its absolute peak, precisely the moment history keeps demonstrating with remarkable consistency, when abandoning ship tends to lock in the worst possible outcome rather than avoiding it. In the end, an 80% collapse in the S&P 500 would almost certainly rank among the most severe financial catastrophes in American history, a scenario capable of devastating retirement savings, employment, business investment, and consumer confidence on a scale genuinely comparable to 1929 or Japan's lost decades. It would test pension systems, strain government safety nets, and permanently reshape an entire generation's relationship with investing, the same way the Great Depression shaped the risk tolerance of the generation that lived through it for the remainder of their lives. But history, imperfect and often painfully slow as it can be, also suggests something genuinely important, that financial markets are ultimately driven by both cold, hard numbers and deeply human psychology in roughly equal measure, and that while fear can annihilate stock prices with breathtaking speed, confidence in the underlying value of productive, innovative businesses has, across every single severe crisis in modern economic history without a single exception, eventually returned. The biggest lesson embedded in this entire hypothetical nightmare isn't that anyone should expect to accurately predict the next 80% collapse, since neither the sharpest economists in 1929 nor the most sophisticated risk models heading into 2000 or 2008 managed to reliably forecast the specific severity or timing of the disasters that followed. The real lesson is that genuine long-term wealth isn't actually built by successfully calling every market top and bottom, an almost impossibly difficult task, even for seasoned professionals. It's built by understanding, at a genuinely deep level, that economies rise, fall, adapt, and reinvent themselves across decades, and that the people and businesses who keep creating real value, solving real problems, and serving real customers, however dark the immediate financial storm may look on any given afternoon, are ultimately the ones who determine where markets and the broader economy, built alongside them, eventually end up.